Sarah Ketterer. You know her, of course, Causeway Capital Management, CEO, portfolio manager, responsible for investment research across all sectors. Sarah, you founded the firm, 20 years ago? So with your level of expertise right here, right now, where do you go for pockets of opportunity when we have these valuations?
I think we have to take at least half of Warren Buffett's quote, which is be greedy when others are fearful. And there are two areas where the market seems to be particularly fearful. One is COVID Delta variant affected stocks that have traded off significantly from their highs, and they're in travel, leisure, and related. And then the other is Chinese internet stocks. They have, I don't think unpopular even begins to describe how much investors don't like these and can't wait to get out. But in both those categories, there are opportunities that if you're willing to be patient and wait a couple of years, especially for economic recovery associated with the what we believe is actually soon to be the end of the Delta variant, and getting back to normal, there's a lot of travel opportunity ahead, a lot of repressed demand for travel.
Well, let's talk a little bit.
Companies.
Well, Sarah, can you talk a little bit more about some of those travel opportunities? Because we did see investors embrace a lot of those travel stocks earlier this year, and then I guess they got a little bit rattled here by the emergence of the Delta variant here. When you look at travel, is this about betting on hotels, betting on airlines, or is there something a little bit broader, something maybe a little bit more esoteric that investors should be looking at?
Some of those airline hotel stocks, there are great ones. I mean, one of the airline stocks that we like is Air Canada, only because when it comes out of this and international borders open, they have only one competitor who's sort of weak. And that's always a nice position to be in when you're an airline. But let's go capital light, where there isn't much fixed cost. And these are really flexible businesses that can last a long time, even under duress, like travel software. And stocks we like are in the global distribution system area. They provide the software for travel agents, connecting them to airlines, hotels, rails, and rental car companies, cruise lines. And they are companies like Amadeus in Spain or Sabre, listed here in the US. They're so efficient now that they've had to cut everything they could possibly cut to get through 2020. And they have tremendous amount of gearing into recovery. And yet investors have taken a very short-term time frame, which gives those of us willing to look out 2 years and see the gradual or maybe even more precipitous recovery in corporate travel and take advantage of that.
Sarah, on that note, it's interesting. The pitch for mutual funds, and this really comes as a time as you're talking about what investors want. When you've been battling a lot against some of the lower fee, lower cost index sort of ETFs, what is the case here in this market for a mutual fund when, well, ETFs also seem to be all the rage?
Well, diversification, one area. The beauty of active, and you can get, I guess, some ETFs in the active space, but they're somewhat new. In mutual fund land, you get this professional manager, group of managers, in our case, 8 portfolio managers, all focused on ensuring that we outperform our benchmarks. And that's really hard to do if you're just constructing ETFs on your own. But what makes me nervous, you noted earlier in the broadcast, everything's at a new high. And with so much valuation optimism priced into markets, that's where having managers who are looking, as professional investment managers, we're looking for opportunities like travel, like Chinese internet stocks, and doing thorough analysis, really kicking those tires hard to make sure these are well-managed companies in the right franchises that have the staying power. Yeah. And that's, again, not something in a passive environment one is likely to get.
Sarah, dig into us a little bit with the China focus, because you're so fundamentally based, but how can you see the fundamental value in, companies that are at the whim of a government to change their desired enforcement on certain industries, decide that they should no longer make profit? How do you navigate that, even if the business is well run, well managed?
The education stocks, that was, I think, a surprise to many, certainly to us. And that might have been a step too far in terms of regulation. But we use the mantra that likely most regulation in China, as in elsewhere, will be rational and not an effort to destroy growth. After all, GDP growth is one of the big goals of the Chinese government. But there are companies that are somewhat out of the fray and also may benefit as their major competitors are reined in, such as JD.com and e-commerce. Here is a company that is the second largest e-commerce company in China, and they're focusing rapidly on expanding and investing in areas such as community group buying, where they're not only add to their own growth, but perhaps take some share from the former incumbents. And they're not in the regulatory crosshairs. And we'd argue the same is true with Baidu. This is a stock that, again, these stocks are on 60+% from their highs.
Yeah.
And they have a tremendous, if you're willing to be patient, upside potential in our view. And in the case of Baidu, gets some of the best AI technology in China and autonomous driving, not to mention smart systems. They're positioned to help the government achieve their 5-year goal.